We're going to go ahead and get started. So thank you guys for joining me. I appreciate it. We're going to be going over some tertiary market updates and understanding sort of what they are and how they can be how they can provide value to your portfolio. So quick introduction. My name is Solomon Floyd. I'm the owner and founder of Reunion Investments. We are an economic development firm specializing in tertiary markets and military communities. Our focus there has led us to some amazing insights and opportunities that we've been able to really find for our clients and be able to forward a lot of these beautiful opportunities and markets to investors from all over the world. Successfully over the past 5 years, we've been able to deploy 27 million total dollars to our markets, and we've got a rental portfolio of about 2,000 units, primarily housing military members and individuals in tertiary markets. So we're going to get started. The biggest thing that we get started off with first is, what is a tertiary market? So I do have some examples for you here. And a tertiary market is a place that is outside of a primary market. So the way real estate works is you have your primary markets like Dallas, for example, or Fort Worth, or any of the larger cities. And those are primary markets. Everybody moves there. Everything's very expensive there. Real estate is a challenge to be a part of if you don't know what you're doing, and you may lose a lot of money if you don't know how to invest there. A secondary market is a market where people will move out to, commonly known as suburbs. People don't spend a lot of time building high rises or skyscrapers and will often commute between the primary markets should they need to. Your tertiary markets are completely independent economies of both the secondary and primary markets. The other two, primary and secondary, rely on each other's economies more than a tertiary market will ever do. The tertiary market is often left alone and oftentimes neglected because they're quite far out. And with that, provides a host of opportunity and challenges for the people who identify the opportunity there to get going. So I will show you guys one of these markets. We're going to be starting off with one of my favorites. It is Lawton, Oklahoma. Lawton, Oklahoma is one of these areas that is oftentimes swept over by investors, primarily for the reason that it has military members, and a lot of individuals do not like or understand how the military works. So for most of us, if we were to rent out a property to a military member, those military members can break their leases when they get orders, which happens a lot often than people expect. And when that does happen, it leaves the landlord high and dry with a property that they now have to try to find to rent out. What a lot of people fail to realize and recognize is that the military exists like oxygen. When one person leaves, the spot that they had must be filled. And so what we're doing is building in these areas for not only the military, but also the civilians. So this is a military market. Lawton, as you can see, is not a big place. Up here is Fort Sill, and down here is where everybody else lives. Based off of what you can see from here, Fort Sill has everything that you could possibly need for a military artillery base. It's got its housing over here, dining hall and other facilities, runway, the whole 9 yards. These are all used to house training troops, which means your permanent party people, the people who live in this base and work on this base, all live here. They live in this area. And highlighting this area is very key because you'll see in a tertiary market, for example, if I wanted to buy a house, there's a lot of barriers to entry because in these markets, the things there are so cheap that you're not able to afford the loan that also pays for the house and the rehab. It's one or the other. And there's VA style loans out there that allow people to purchase either one, but depending on the buyer, that's essentially what really comes down. So as you can see here from our little Zillow map, and I don't really like using Zillow as a tool, but for the purposes of the webinar, it's going to help me convey a few things to you. Ranging from our price right here of $15,000 per property to $40,000 per property, this is where you, the investor, can find things that other people aren't going to be able to find in these primary and secondary markets. In a place like Dallas, a property like this, that's a 4-bedroom, 2-bath, that's 1,500 square feet, is going to cost you an arm and a leg. It's going to cost you way more than 40 grand, guaranteed. And so when you click on something like this and you see it, you may think to yourself, wow, man, that's great. That's amazing. How is this so cheap? But what you must understand is that with how do I turn off representing? We're going to stop presenting. There we go. So what you must understand with the tertiary market itself is that they exist solely opposite of the primary markets. They don't have multiple businesses there that fuel a lot of the economy. They really just have 1 to 5. And those 1 to 5 will either be a military base, a university, either agriculture, or whatever that industry is. The livelihood of that market itself is tied heavily to the one specific industry that's there, which makes it almost a little more risky than some other markets. And with that risk comes a lot more reward. Now, with that being said, you'll be able to identify a lot of the things in tertiary markets of the simple tertiary market checklist here that I've created. So the checklist itself really comes down to identifying a population of, at minimum, 100,000 people. I'm so sorry. Do I need to turn this? What direction? This one? Oh, back this one. We're good to go. We're good to go. Solid. All right, perfect. Thank you, Gary. So a tertiary market itself, you're going to look for a minimum of 100,000 people. Reason being, you want a population of people you can kind of pick and choose from. Your job as the tertiary market investor is not to provide housing to 100,000 people. You want to aim for the soft spot of maybe 300 people, right? Because you're an investor, you've got things you got to do and you want to grow. So you want to make sure that you're providing for a portion of the people, not all the people. The other thing you're going to want to look for are 1 to 5 reliable employers. Those are going to be your military bases, like I said, right? Your processing and shipping facilities, your agriculture, land development companies that go out there and buy and rent and manage farms. They usually have enough people to support the economy, primarily just because that's what everybody does there. You're looking for a university if they have it. And some of these places may have a combination of both, which is why you've got 1 to 5 here, right? You're looking for distressed real estate. Now, from what we saw and what we'll see as we keep going through this webinar is tertiary markets have a lot of properties that are just abandoned, that are just torn to garbage. And it provides you a lot of opportunity, whether you're going to rehab, flip, or you're going to build new. It gives you a lot to work with at a very small price. And a lot of our tertiary market prices are anywhere from $15,000 a home to $45,000 a home. And that's for an unrehabbed home, a distressed property. You're also going to look for that larger rental population. Because there are so many distressed properties, you really don't have to worry about there being as much competition against you for people looking for rentals. Because at the end of the day, if these 300 people can't find that rental property and they can't get what they're looking for, they're going to go to the person who can provide that to them, which is they're going to go and rent from the person that has the nicest property. So for example, with COVID-19, in a place like Dallas, right, tenants can leave freely and go anywhere without fear because they can always find a place that is equal to or better than where they were in the past, thus making it the tenant's game. In a tertiary market, it's the exact opposite. Because the landlord has the nicest property, it has the property that is the most up-to-date, it has a property that is the most livable, it'll be the most desired piece of real estate there. So should one tenant not be able to afford, the other tenants will be able to join in and take it off your hands for you. So you see your vacancy periods go down depending on how you market to people in these tertiary markets. And then we're going to go back and show you some more of what that means here. So let me open this back up. So when we look into things like rentals in a place like Lawton, Oklahoma, you will see there's not a lot. And the base price of what you're trying to stay within is, oh, thank you. The base price of what you're trying to stay within for your rental period would be anywhere from $850. Oh, that's why I have it backwards. That's incorrect. This is supposed to be $1,200 and $1,200, $850 to $1,200. So it gives you a pretty wide array of what's available. And this will let you know what people are living in and what they're paying for. So if you can find a property, for example, and you say to yourself, you know what, I would live there, then that's a pretty good property that you're going to want to try to stick with and mimic, depending on how many people are looking and interested in this one, right? This property's been listed for a day. It looks like it's in relatively good condition from what I can see, but that's just the one picture, so not our best one. But for example, when it comes down to it, 1,450 square feet, 3-bedroom, 2-bath. For most of these tertiary markets, that's going to be the commonality, especially with a lot of these rehab homes that you're going to try to buy, because the rehab homes are going to require a lot of configuration depending on the year and date. So this is going to be a newer home here, but as we keep going, you run into things like this: $800 a month, basically $850. At $850, this is where people are living in. Bad drywall, you can see, right? The shower is a little molded and outdated. I mean, the only thing that's really new about it is the shower head. And again, that's as far as I get, but you can see that the quality isn't really there for somebody to want to really pay this amount of money, which is probably why it's been listed for so long, especially in a place where the military is constantly moving in and out. And that's where you have to identify these opportunities, because if you can provide better, you will get better. And that's the whole shebang about tertiary markets, is when you're coming in as a rental landlord, as somebody who wants to own properties for cash flow, you have to identify the only way for people to get that cash flow. And that is, how is my competition getting rent? What are they doing? What aren't they doing? And that's a matter of making sure that we have exactly what we need to make to provide these homes for people. So coming down into it, the things you want to do when you identify a market like these are identify your people who are going to be there, right? Whether you're going to flip or whether you're going to rent. In this case, I'm going to rent, because I know that when I type it in here, and just so you know, how we identify our rents for military members and within our entire market is at the traveldefense.dod.mil site. This is the BAH calculator. BAH stands for Basic Allowance for Housing. So military members get this pay on top of their base pay for living off a base or living outside of an area. So when this happens, we usually start at E5. So just so you all know, fun fact, E1s through E4s are required to live on base. You can move off a base when you're in E5. This rate is based off of the zip code that is in Lawton, Oklahoma. And when I press calculate, this is my result. I can rent to one E5 without dependents, which are without wife or kids, for $747 a month. Letting me know that if I can beat the status quo with the $700 properties, I'm going to be able to attract more of these people, because that's what the need is. With dependents, it's $888 a month, which is still really good. A lot of these military members make this money tax-free, which means they get the bulk of this money solely to live off of base. Now, from the standpoint of economic development, what we do is we identify the market and we say, hey, here's our opportunity. Our opportunity is going to be Lawton, Oklahoma. Well, I know that if I focus on providing homes right outside this base out here, I'm going to be able to make sure that life is going to be better for these people. But I'm not just going to focus on the housing. If I can get a bunch of families to pay $700 a month in rent, they have an additional $100 to spend, hypothetically speaking, on the things that I can provide. So I'm going to provide and build commercial opportunities. I'm going to put in there industrial opportunities. I'm going to put everything that I can to bolster the success of these people staying here. Now, a lot of you may be saying, well, what happens if the base closes? Usually a base closure happens when the military decides that the area around the installation can no longer support the mission. And that is a matter of opportunities for jobs after they leave the military, growth for the military to partner with or have any sort of housing or creative developments or commercial developments. When that stuff stops in a military community, the bases leave. A military base's goal is to expand its mission and continue that mission. And if these communities around these bases don't meet that, then the base leaves. So as long as you are developing, growing, and paying attention to the needs of what this market is, you're going to be able to succeed, and you're going to make sure that you ensure the longevity of this military base, which thus ensures the longevity of your renters. Now, you may be thinking to yourself, what about the civilians? The civilian renters themselves are always going to be second fiddle, at least in the primary first stages of this, which will be your first 5 to 6 years of investing in this market. Now, with that being said, they're going to work at places like your hospital, right? They're going to go to the university. They're going to work at the university. They're going to work at all these little businesses around town. And it's your job to provide them a better place to work. Once you do that, and once you've achieved this, depending on what your style of real estate investing is, our commercial investors will put things in here that provide better services, like a coffee shop. There's a better coffee shop out there that can always go, and that'll cater to military members 100%. So if I put a coffee shop, a Mexican joint, a dry cleaner, and a liquor store right next to each other in a very nice new renovated shopping center, I now have civilian employees who are going to be working there, who are going to be making more money, because the military is going to be spending the bulk of their money there. They make more money. Guess what they're going to need to do next? They're going to need to rent homes from, you guessed it, us, or we, the investor. And that's why we identify what we need to identify in a tertiary market. So coming back to me, the things you want to focus on are Identify your opportunity with the housing that's already in place. The housing that's already in place is going to be key because what it's going to allow you to do is build your portfolio. And building your portfolio, the things that you truly want to focus on are conducting the market test, right? Where can I push the boundaries? What are people going to be paying for? You don't want to overinvest because you don't want to lose that money. What you really want to focus on is building for what's already there, just that step up, right? The next step up, the next step up, the next step up. So that way you can keep testing what is going to be the best route for what you're trying to do next. Coming through here, you're going to establish your comps. That's the other big portion of it. The more you do in this market, the more that you improve, the more that you make things better, the more there'll be comps like that. And it's always key that you invest in an actual strategy. And what I mean by that is most people like to invest like this. We'll call this Dallas. We'll call this, I don't know. Oh, they can't see it. Funny. Better? All right. We'll call this area Waco, and we'll call this, I don't know, call this Frisco. Most people will tend to invest, house here, house here, house here. This is this typical method of real estate investing that makes trouble for a lot of areas and a lot of investors. Instead of focusing on the area as I'm going to invest in one residential in Waco, and then every 5 years, I'm going to sell off a bunch. So you can have whatever you want. But ideally, let's say you spend a lot of your time developing in Waco. Now you've bolstered the value in this market because you've put a lot of your attention there. You've already established these comps, which means when other people start buying and selling homes around you, your numbers are going to go up. And when you have a bunch of rentals that are high comp rentals, it means that now you can start selling off your inventory versus trying to wait on other people to bring up your comps for you. And that's what a lot of people do. They invest in these one-offs in these primary markets, and they're expecting the rest of the market to rise up with it. The problem with that is in a situation like COVID-19 or the great crash of 2008, you'll see all those markets come down because people aren't paying rents, because people aren't being able to pay their mortgages. And that's an issue in these markets, especially if you're relying on everybody else to bring those values up. So when all the foreclosures happen, that brings all the cost of homes down because that's what's been established here by the people who are already in these markets. Versus if you focus your time and attention in one market and bolster that little community to grow and become something better, you have a better chance of actually selling off your portfolio because you're the one in control of it. It does take a lot more time. It takes a lot more focus, and it definitely takes a solid mindset of knowing how to invest in real estate. But if you did it the right way and you focus on the one place and you grow your portfolio there, you'll be able to see your investment triple, if not quadruple, every single time that you try to sell something off every 5 or 6 years or so. All right. So that's one of the best reasons to invest in a tertiary market that I could possibly ever tell you. Now, the other thing about a tertiary market is this: because they're all distressed houses, you're eventually going to run out of inventory, which I think is phenomenal. It's by far one of the greatest reasons to invest in a market like this, because at the end of the day, you now get to start building new homes. And you may come across homes where, you've had to pass on them in the past because you're like, this home is it's too beat up. It's too janky. I can't get the rent that I want out of this home if I fix it up. So what you do is you demo the home. And we're actually going to go through that right now. I'll show you one of the best reasons to demo a house ever. And that is because at the end of the day, you are focusing on providing, there we go. You're focusing on providing that value and maximizing your investment in that market. So once this comes back up, we got the photos back up. Huzzah. All right, so as you can see, a home like this, right? You could rehab it, you could fix it, but let's say you didn't want to. Let's say you had to pass on this home multiple times because you weren't able to make anything happen here. But it looks good. It looks good for now, but we're hypothetically speaking here, right? So we'll come in and take a look at the lot size and we'll be able to see. Now in a place like Waco, a place like Lodden, a place like Wichita Falls and Burke Burnett, homes sit on very large lots. There hasn't been a lot of demolition to make way for new homes, and there hasn't been a lot of restrictions on things like that because these homes are older, and these communities don't really have rules or regulations for things like going in and building and designing. So when we look at the lot lines, the way that I see it is By the time you've already started selling and buying and doing everything in this market, you can take advantage of how big these lots are. Now, it depends on the market and what the need is. But here, that's a really big lot. This is a really big lot. What I would do, and what I think a lot of us have started seeing the trend in tertiary markets being, is demolishing homes like these to build 5, 6, 7, 8, however many townhomes that you can. You see, the thing about tertiary markets is the lack of homeownership is what hinders people's ability to see large comps, which is why when we follow the strategy I have up on the board of investing in that one market, you can increase homeownership. As you increase more homeownership, people will take care of their properties, they take care of their properties, they do what they need to do. And you see that valuation rise throughout your entire neighborhood as you make affordable housing the key. Now, I'm not saying everybody jump on the affordable housing kick and start knocking down properties left and right. Everything has to follow a very specific, detailed outline. But when you get to the end of your outline and you are running out of properties to rehab and you can't go any further with your rehab process, it's time to start knocking down old distressed homes. Now, one of the easiest ways you can go about doing this is actually partnering with the city. And partnering with the city, you can have unlimited opportunity. It's a lot easier for us to partner with a tertiary market than it is a primary market. Everybody in Dallas wants to partner with the city of Dallas. Everybody wants to work with them. Everybody wants the keys to the palace. If you control the city of Dallas, you can build and do whatever you want. It's very difficult to do that. There's a lot more people here. There's a lot more representatives. There's a lot of laws in place in a place like Dallas. You go to a tertiary market like Lawton, Oklahoma, you can call the mayor, you can call everybody right now, and they'll all answer, they're all picked up. They won't be too busy for you. What that means is there's not enough projects, there's not enough development happening in a market where these things would be necessary. So for us, we identify, let's say we got 1, 2, 3, 4 of these homes, and we were able to build, I don't know, we'll call it 24 townhomes. Now you have the option of building these 24 townhomes and either selling them or keeping some and selling some or keeping them all as rentals. Now, because you have again, we go back to having the nicest homes or the better homes in the neighborhood, you've been able to give yourself the ability to house more people and provide that home ownership to the next level. Thus, in turn, following the steps I have outlined here to make sure that you have it. So no matter what, the strategy that you need to follow in a tertiary market in order to see that return is right here, which is you need to identify the opportunity with the housing. Again, I say start with single family and start with rehab because that's usually the easiest way to go. It's a good step in and it's very easy to offload those properties. You need to decide whether you're going to flip or rent. That's the same thing that also goes for the new builds as well. So for any stage of what you're looking to do in these markets, following this outline is something that's going to make it substantially easier for you, as long as you do this instead of this. Now, it's okay to have properties in other portions of the world or all over the country. That's totally cool. I'm not against that. What I'm against is putting them out aimlessly and relying on the rest of everybody else to bring your properties up. Because what we're seeing now is this huge decline in people living in these areas because of COVID-19. It's been almost 3 months, if not 3 months, since this really took over. And we're not seeing nearly as many homes being bought. We're seeing a lot of rents declining. In these tertiary markets, we're seeing a lot of people focus their money here because it's safer. Smaller populations, right? $100,000 or more. And that's going to be key because, again, in a place like Dallas, instead of 14 million, 100,000 is a lot easier to manage. 100,000 is a lot easier to test. 100,000 is a lot easier to stop community transmission of this virus and this issue. And that's one of the things that, again, a lot of people aren't focusing about tertiary markets and primary markets. Can you please grab my charger, Garrett? Thank you. So coming in here, it's building your portfolio based off of what you do. So depending on, right, with your rehabs, we'll say a hypothetical situation of what we've been able to do for a lot of our clients is we'll get them into 5 or 6 rehabs, single family. And they will always sell off 2. Always sell off 2 because 2 will help you establish those comps. Now, when you really want to start selling and pushing your portfolio, you'll start selling off 4. Now you've sold off all 6 at around the same price because you've already had these 2 to support. In a primary market, you're going to see your appraisers are going to want maybe 5 or 6 selections to pull from because that's a primary market and that's what should be charged. No, for my computer. It's in one of my bags somewhere. I don't know. You got to search for it. I don't know where my green bag is. Anyways, so as you can see, right, what this really helps with is you being able to off-sell all these properties. Now, even if you wanted to do a rehab or a value add with a new build property, it's really going to be able to show that you have the ability to do everything else. Give me 1 second, guys. Garrett, by the couch. On the other side of the couch is my charger. Even if you did value add multifamily, what you are going to see is a huge wave of people coming to live in these multifamilies because you can get your rents low. They have a place they can put their head down, and it's not that big of a space. Now, the question is, how many of these people are going to be selling their value add multifamilies? That depends on the market. I know in a place like Wichita Falls, right now we're looking at about 14 different multifamilies. They're totaling a couple hundred units, but it's nothing crazy, right? They're not huge. But what that does give you is the ability to rent to these military members in a large fashion because you can always turn over that multifamily a lot easier than you can turn over the single family. And that's one of the best parts about multifamily in these markets is the risk is a lot lower. The ability to offset this thing and sell it off a lot lower. And that's one of the best parts about tertiary markets. We're going to get into the other portion of it. Which is tertiary markets have one big centralized problem. And the big centralized problem is this: there's a lot of old people there. Now, a lot of old people in a market really mean one thing. There is not a retirement facility large enough or fancy enough or whatever to supply and support the needs of the elderly in that community. So what do? They hold on to their properties. They invite their children to live with them. They do everything they can to make sure that they have someone to take care of them. So what a lot of people should start doing, especially in any market really, is identify where all the elderly, so 55 and up, people are going to be living, and identify which properties have problems. Not all 55-year-olds are going to say, yeah, 100%, come move me out of my home. But you are going to have a large success with some of them. It should look something like this. So you'll have a few homes that are all going to be 55 and up. And the problem you're going to have is they're not going to be able to sell their homes for $35,000. You're going to want them for 35, but you can't buy them for 35. Reason being, there's no place for them to go. There are no new homes, and $35,000 only buys them another piece of garbage that they were living in. So what we have to do is identify that opportunity for them of why sell to us. And this is where we come in as, again, the investors, the people with the money to be able to do this. These people aren't going to have anywhere to go. And because of the lack of retirement facilities, you need to create a retirement facility. That's a very big undertaking. But if you can identify how many of these people exist here, that should be more than enough to get you where you need to be, especially if you can get them all to commit to going before you start the process of building this facility. So let's say you build this facility out, I don't know, boom, boom, boom. Let's say 35 units. And at 35 units, you are making $2,500 a month per person. That should be $87,500. I believe that my math is correct. That is how much you'd make monthly gross off of these people you're being able to sell these homes off of, be able to buy these homes from, right? So then one of us, right, doesn't need to be every single one of us, but another investor, another person, the other thing, the aspect of this that makes sense is now, let's say we have investor one, and we have investor two. Forgive my handwriting, guys. All right, now this goes to investor two, and we can take investor one and place them here to purchase these homes and turn these into rentals. So now we have better homes and a higher value. Now, an elderly care facility in a tertiary market is primed for the reason that these people have disposable income for the first time in their lives because they don't have as many expenses with their homes. So now I can take them over here to wherever my commercial buildings are. And I actually probably put them in the wrong spot because that's not correct. So the way you think about it is, and the way that Reunion thinks about it is, homes are here. We put all of our commercial up here. because the commercial is going to be what provides that value, like I mentioned earlier. If all of these people are living and enjoying themselves and having a good time in this neighborhood that you've now created, they're going to want to spend their money here. And now the people who are the lower income individuals have better jobs because you built a brand new commercial center that allows these people to enjoy living here. And now they're going to rent homes over here, right? Because if there's one thing about human nature, everybody wants to live in something better. Nobody wants to live in a matchbox. And if they do, more power to them. But the idea is this is how you turn around a tertiary market, and it doesn't cost you nearly as much. If you were to try to do this in Dallas, you're spending millions of dollars. If you're doing this in a place like Wichita Falls or Lawton, Oklahoma, we'll take Lawton, Oklahoma, for example. To do this very small, similar concept, you're looking at about $750,000. Now that's financed, but it does get you to where you need to be because this is how you build that portfolio of wealth. Because at the end of the day, this is something you package off and you sell to a REIT, or you sell off to other investors, or you keep it to keep perpetually going. Because at the end of the day, that's all that matters. These elderly people are always going to have that money coming in from the government. So far as I've checked, the government has not had very many problems paying out its people for Medicare and Medicaid. The other assistance programs, maybe a little bit, but everything else in between has already come through, especially if you stick with my favorite clientele, the VA. Veteran Administration's healthcare for its aging population is through the roof right now. And a lot of people aren't accepting their healthcare because they don't like how long it takes to pay. If you can wait 30 to 60 days to get paid off of the first initial invoices, then it's going to be the one to go for because these people are always going to pay. The VA is always going to pay. It may not pay on time, but it will always pay. And so from here, you're able to create something that is beautiful. Now, again, if you stick within a military community, these homes are either going to be flips or sales. I'm sorry, they're going to be flips or rentals. And that's up to you to decide how you want to go about doing that, but make sure you keep that ratio so that way you aren't falling behind. Because the moment you start producing quality inventory, it's going to go like hotcakes. And the moment you stop is the moment somebody else gets started. You want to make sure that you have the ability to control as much of this as possible by maintaining the grip on, how many homes you have for rental versus how much you have for sale. Then from here, with this commercial side, whether you do it or somebody else does it, this is going to be the main thing you want to focus on. Because at the end of the day, it all provides value all the way down. All the way to two investors who got this started, right? Or maybe the 100, or maybe the one, whoever does it. This is what generates that long-lasting generational wealth versus a property over here, a property over there, a property over there. You want to make sure that you're centralized with the way that you're doing your investments. And with that, I am taking questions. Go ahead and unmute yourself if you have a question, people. Or I guess you can type it in the chat. Lovely. So as we keep going, it's all about development. And this is a very small form of development. It's not super intensive like we would see in a place like, again, Austin, San Antonio, Dallas, or Houston, or any of our larger cities. This development happens from being able to identify the opportunity that exists in one singular market versus identifying the one singular investment opportunity in a lot of markets. And when you spread your investments out like that, you're opening up yourself to a lot of risk, especially if you have Airbnbs or if you have, hotels and things like that. They took a really big hit during this. And a lot of them are going to have some struggles coming back up for air. But a lot of them will come through and hopefully they'll pivot and develop and change and become something brand new. And there will be its own thing. Now, what to look for in this era of COVID-19, people across the entire country lost their jobs. And a lot of people are about to start going through the foreclosure process. So you want to make sure you educate yourself on how to bid on foreclosure auctions, how to have a realtor that, understands the foreclosure process. So you can start taking advantage of the opportunity that's out there. And I don't mean take advantage in a negative way. I mean it more in the sense of see the opportunity and seize the opportunity. Now, if you're waiting for all of that, these tertiary markets may be the perfect place because at the end of the day, they're cash flowing now. The people out there are still buying homes because their markets and their entire economies are solely independent of Dallas, that this is generating money while your stuff in Dallas isn't. And while this generates money, this means it's leverageable. The retirement facility, leverageable. These rentals you have, leverageable. This commercial you have, leverageable. It means you can go get a loan against it and you can go and buy the larger stuff that you want. And so these type of portfolios, again, will keep you wealthy, and they will allow you to go buy all of the one-off properties you want. And they'll give you that ability to make sure that no matter what time, no matter what happens, these are going to be the things that keep you in the game for the longest period of time possible, depending on how well you do and how much you help this market diversify. So with a company like Reunion, our idea is we do this entire concept, but we shell it out to all of our investors. So we may have, a few of our investors come in this area where the residential homes are, and we'll have them build new homes, or we'll have them rehab homes and rent those homes out. And eventually, 1, 2, 3, 5 years down the road, we will sell those homes off to raise those values. And when we've raised the values to enough to where we can't go up any higher, we'll start building new homes. And when we start building new homes, now we have higher values. When we start building new homes, we'll start building our commercial. Give these people a reason to want to buy your new homes. Give them a place to go. Well, when you start doing that, the people who live in these rentals are going to come and purchase these new homes. The people who work at the commercial properties are going to be able to move into your rentals. So you're always going to make sure that you have that ability to come into play as long as you're working with a union, because we thought this through. We've worked with the cities, we have these relationships where we can identify the opportunity and build on that to make sure that it makes our investors and our clients wealthy, while also providing a much better community to the people who live there. And that's essentially the whole entire webinar is tertiary markets provide you the opportunity to do something more and to get higher returns. And that's all I've got, guys. So if you have anything else for me, let me know. But I appreciate your guys' time. Thank you for being here. If you do have any questions, please feel free to book some time with me at Reunion Investments LLC.com. Garrett will type that in the link for you, so that way everybody has it. We also are on LinkedIn. Feel free to like us there. We always have great content. And we're going to be launching our YouTube series here relatively shortly, so feel free to catch that as well. If you have any questions, feel free to type them in or unmute yourself and ask them.
Hello, can I ask a question?
Sure, absolutely.
Yeah, so I was wondering, so it seems, so what you explained, I think is pretty nice, but it seems you need several investors who invest at around the same time, right, to get this going. So how much you need to raise right now, and what are you expecting people to invest? What's the total amount of money you're hoping to raise, and how many investors are you looking for, and so on?
Absolutely, appreciate it. Thank you. So what we've been doing is, for the past 5 years, we've been able to market individual properties within a plan. So with our investments, the majority of our investors own their equity. So we don't really have to raise money or projects around that. We will if we have to syndicate or do a JV with a deal. But for the most part, we primarily focus on putting people into a plan. So for example, I can get these homes under contract with these 55-year-olds, but it's up to Reunion Investments, my company, to sell the idea of the retirement facility. So I may need $600,000 for somebody to come in here and do this. I'm either going to go find an investor who has $600,000 or find an investor who's willing to finance and leverage this to build it. I then need to find investor one who's going to buy these homes after that's been taken care of. So this is the cycle of my company takes care of identifying these opportunities for each investor. And that's the reason why we do, a lot of our marketing, we do a lot of our speaking events, and a lot of our, our own actual content is because teaching people that this is the way that investing happens most frequently is a little bit easier. So when it comes to raising money, we usually don't have to. Our minimum to invest with our company and own property with us is about $200,000, depending on the opportunity. Some of our smaller opportunities we will raise money for. So we've got some smaller JVs and joint ventures and syndications that will require things like $15,000 to $45,000, sometimes upwards up to $2-3 million. And we work with clients in a range from institutional money to individual investors to groups of investors. So we work with everybody as long as their goals align with us working to better the communities that we serve.
Okay. So have you had a history? I mean, have you So right now you're focusing on Wichita. Is it the community that you're focusing on right now?
So we're focusing on Wichita Falls, Lawton, Oklahoma, Baltimore, Midland, Odessa, which is in Texas. We're focusing on Panama City Beach, Florida. Let's see. We got Minot, North Dakota, and that's about it for right now.
So it's basically using the same model for all these different places.
Similar, yes. It's a matter of identifying the opportunities. So as long as I can see where I can provide that value to that market, that's where I'm going to put the money, is where that opportunity is going to lie. Then I'm going to grow from there. So for example, we take Minot, North Dakota. That's an Air Force base that's up there, and there's nothing around. The closest city, not the closest, but the most fun city is Denver, Colorado, 4.5 hours away. So why would troops want to travel from Minot, North Dakota to Denver? Because it's the only place to have fun. Well, as an investor, I think to myself, I don't need to focus on the residential. That's already in existence. That's already there. I need to focus on the commercial. So I'll build the commercial and start here, and then I'll build the residential, because this is where everybody's going to want to be. So this is where I'll probably focus on multifamily primarily, because I have a lot of single airmen, a lot of single troops there who are going to be able to enjoy that commercial space. And that's what I'd raise money for. So for example, in the case of where you asked me, how would I raise money for this? I would shop this as a syndication, the commercial aspect, and I would shop the residential as an individual purchase. So I would have individual investors purchase the land and either turn it into housing or turn it into multifamily.
So what has been, so to date, your records in terms of return on investments from what you did in the past?
Absolutely. So our record so far, the majority of our investors have seen anywhere from a 25% to 35% cash on cash return for their rentals, sometimes upwards to 50, but primarily for single family. They'll go up higher for their multifamily properties, but we don't have a lot of that data that I can share with you, because a lot of it is very much private. And then we have our new build properties. So our new builds are the stuff that we do a lot of with our joint ventures. And those are anywhere from 70 to 80% cash on cash returns based off of the flip models that we have in place. Now, let's say you want to build 8 townhomes, but you want to keep 4 of them and you want to sell 4 of them. That may change the metrics, but you should still be around a 50 to 60% cash on cash return if you did that.
I mean, you're not talking about 50% on a yearly basis? No, that's over several years?
So that's 50% on a yearly basis, cash on cash return. Exactly. If we were to annualize it. Okay. And the reason for that is because our properties are so cheap. So coming back to what we were saying earlier, tertiary markets, these properties are cheap. These properties are $35,000, $45,000 versus in a primary market, they're going to cost you a couple $100,000. And it's really the same amount of material, the same amount of square footage. The difference is just the market. And that's what I was saying earlier, is everybody's waiting for these markets and places like these primary markets for everyone else to bring up that value for them. They buy one property and they think that's all I have to do is just buy the one and I'm done. In our case, we buy up everything because the goal is to appreciate everything in a controlled manner, to where no one has to wait on the next person for the next person, because if something happens, everybody's investment falls to the ground. Our goal is to make sure that everybody's investments can rise up together, which make it easier for us. So let's say you get a property for $35,000 and you build 8, let's say we build those 8 townhomes on there, right? You're gonna sell 8 of those townhomes for $200,000 a piece. They still fall underneath the qualifications for a VA loan and the affordable housing loans. So now you've been able to provide housing to people who truly need it and make your money back. And all it took was a $35,000 purchase and maybe $175,000 down. And that is an annualized return of 70%, give or take, depending on how the model operates.
Sorry, I have one more question. What about property management? Do you take care of that, or?
So Reunion does take care of the property management, and the way that our company works is we help you identify the market, we help you implement the strategy, we help you do the construction, and then we help you manage the property. We primarily will start, as of this year, we have our own brokerage coming into play. So it'll be Reunion Realty. We'll be taking care of all the property management, the selling, and representation for all of the buyers and sellers. So yes, we do take care of the property management.
Okay, but that's new. You don't have a history of that, right? I mean, because we in California, so we can't go and visit, and we're not close to this place. So it would be like some sort of remote investing,
100%. And so there's actually somebody else on here, Mary, and if I get her permission, I'd love to connect you guys. She's a property manager. So for the moment, we would probably outsource to somebody else until our brokerage is up and running. But when our brokerage is up and running, we'd be able to take care of all the property management with our qualified team, who is primarily property managers. But for the most part, we've been doing our property management via subcontracting. So we would either subcontract or sublease the property from you and then lease it out on your behalf and then send you the rents. And because we take care of the entire step of it all, you really don't have to worry as a distance investor because everything is taken care of and sent to you on a monthly basis.
Okay, thank you.
Yes, indeed. Thank you. Does anybody else have any questions?
Hey, Solomon, this is Mary.
Hey.
Thanks for bringing that up. Yeah, I in 1 year I'll have 40 years property management experience, and 25 of it has been in multifamily. So at one time I had 8 apartment managers working for me, and yeah, it was a pretty hectic job, but there are so many things to learn in this business. I mean, you never know what you're going to come across. But yeah, I mean, I'd love to sit down with you sometime and talk, because I believe we could help each other greatly.
I agree. And so hopefully, if you've got some time this week, I'd love to be able to connect. I have your email, so I'll reach out to you after this, and let's see what we can make happen. We're always looking for more partnerships, so that's always a very big part of how we do operate, is partnerships, because we cannot do it all, and I do not pretend that we can do it all.
Absolutely. That sounds awesome. Thank you, Solomon.
No worries at all. Thank you, Mary. You enjoy the rest of your day.
You too.
All right. Well, if no one else has any more questions, I'm going to call it today. But if you guys like what you saw, please feel free to go ahead and go to our menu pages on YouTube, Facebook, and LinkedIn, so we can all kind of connect. And you can please, hit me back with your feedback. If you do want to connect with me, my email is solomon@hirec.com. Garrett will type that up, but I'll spell it out for you. That's SOLOMON @hirec.com, and that's HIGHER, the letter C.com. I appreciate all of your guys' time. Thank you very much, and I hope you all have a great day. Goodbye.